Row has two financial assets. They are both accounted for at amortised cost, and it has factored them. It has sold them to a bank in return for money. The money that it gets is less than the face value of the invoice. Both assets are high quality. Both assets are expected to be sold in full in 3 months' time. The first is a debtor of 200,000, and in return for selling, in return for assigning the receivable, we get back $180,000. Under the terms of the factoring arrangement, this is the only money that Row will receive, regardless of when or even if the customer is settling the debt. I will receive 180,000. Why have I received 180,000? I've sold the debt. I no longer have a right to future cash flows. I no longer have any reward or risk associated with that debtor. So that debtor will be de-recognized. That debtor will be de-recognized. I will remove the asset of debtor. The financial asset is de-recognized. The financial asset is de-recognized. Row no longer has any rights to future cash flows. Row has no risk and reward associated. That is why we are de-recognizing the debtor. The debtor was in the books at 200 and we sell it for 180. So what's the difference of 20? What is that? What is the 20 going to be? An expense, a finance cost, yeah. So we will debit P&L, we will debit an expense. Yeah, we have factored the debtor, we have de-recognized the debtor, we have sold the debtor disappears. I am happy. This is factoring without recourse. There is no suggestion that we're going to have to pay the money back. So we have factored without recourse. There is no recourse for bad debts. It has no risk and reward associated. In other words, there is no recourse for bad debt. There is no recourse for bad debt. Yeah. In other words, there is no repayment. There is no repayment. So the money I have received is my money. I have sold the debtor. I have passed away the risk and rewards of ownership. End of. The second one is a receivable of 100,000. The second one is a receivable of 100,000. Now again, we assign, again we sell the debtor. But this time we only receive 70,000 in cash. So what am I doing? I am saying, thank you very much, I have received 70,000 in cash. Under the terms of this factoring arrangement, if the customer settles the account on time, then we will get a further 5,000 from the bank. But if the customer doesn't settle the account in accordance with the agreed terms, then the receivable will be reassigned back to Roe, who will then be obliged to refund the factor the original 70,000 plus a further 10,000. Sunday morning, we're having to think. I've received 70,000. I have sold the debtor. If the debtor pays early, I will get some more money. If the debtor doesn't pay early, I will have to give the money back. Yeah, plus. All right? So, what I want to hear this morning is the truth. What I want to hear this morning is the substance. What I want to hear this morning is the economic reality. What I want to hear this morning is the application of the framework, the substance, the truth of this transaction. Why have I received 70,000? What does that represent? Have I sold the debtor or have I borrowed the money? Thank you very much. You understand. Excellent. Yeah? I have borrowed the money. I still have the risks and rewards associated with the debtor. I still have the risks and rewards associated with the debtor. If the debtor pays early, I get more money. If the debtor doesn't pay, I have to refund the money. This has been factored with recourse. In substance, a loan. The asset remains. Risks and rewards remain. Risks and rewards remain. For example, the reward of early and the penalty of late. We would get the reward of an additional 5,000 if the money came in early, and we would suffer the penalty of having to pay the money back. Plus, the monies are refundable. The monies are refundable. We have factored with recourse. We have factored with recourse. So the monies are refundable. You would have to pay the money back. The example is the risk and reward. The example of the reward is that we would get a further payment of $5,000 if we got the money early. The penalty is that we would have to pay back $10,000 if the monies was collected late. So the risks and rewards of ownership remain. Financial instruments is a massive topic. There's lots of little nooks and crannies. Treasury shares, convertible loan notes, derecognition of financial assets, reclassification of financial assets if the business model changes. But I think at the heart of it, it is about liabilities at amortized cost and the classification of financial assets. We spent most of yesterday on it. I'm happy to move on. Financial assets, going. Good morning. Right. Last night, as the evening was drawing in, we looked at deferred tax. Last night, as the evening was drawing in, we looked at deferred tax. Why do we account for deferred tax? Answer, matching concept. It is perfectly possible to report an accounting profit, but for there to be no current tax assessed. I think if you report an accounting profit, there should be a taxation charge. All that you've done is defer the payment of tax. So if we are going to account for the matching concept, then the idea is that we have, the deferred tax. The tax that we haven't been currently assessed, we account for that. So why do we account for deferred tax? Matching concept, accruals concept. How do we account for deferred tax? We account for deferred tax on temporary differences. On temporary differences. And we take a balance sheet approach. We think of assets, liabilities, we think of their carrying value. We then think of the amount as acknowledged for taxation purposes, and we compare the two. And where the two are different, they're different on a temporary basis, and we account for the deferred tax on that difference. What we haven't done is to apply. What we haven't done is an application. Clearly in the exam, there is only ever going to be 1 mark, 2 marks for writing theory that you've already remembered and just regurgitate. The majority of the marks are going to be for a written thinking application. Now, if we have numbers in deferred tax, they're easy, because it's just a tax rate times a temporary difference. So the issue around deferred tax is the analysis, the process. Maybe we'll talk about this for 5 minutes. Maybe we'll talk about this for 10 minutes. I don't mind. Yeah? But we're going to talk about it. You're going to put your pens down. By the time we start writing something down, you will be fully aware of everything that is happening with this very small example. And I promise you, if you understand this small example, everything should fall into place. Yeah? Because the methodology that we can adopt can be then taken into other areas. So, I need to just... Before I explain and talk about the methodology, does anybody know the numerical answer? What is the deferred tax in this situation? Are we being shy? Or are we just being tired? 12.5, yeah, correct. The answer is 12.5. Yeah? Asset or liability? Liability, correct. Yeah. So relax. Some of you know the answer. Some of you know the answer, and the answer is 12.5 liability. But writing down 12.5 liability is 1 mark, and there may be 3 or 4 marks available for answering the question. So, how do we arrive at the 12.5? How do we go through the 3-step process of arriving at the right figure for deferred tax? Deferred tax is provided for in full on all of our year-end temporary differences. So the first thing to think about is that a temporary difference is the difference between the carrying value and the tax base. Step 1, carrying value. Step 1, carrying value. What will the carrying value of the asset be at the end of the first year? 150. All right? Now, that means that you understand that a financial asset, which is fair value through P&L, has to be at fair value at the year end. That means you understand the gain of 50 is appearing in the profit and loss account. You might even have to explain what fair value is in the context of the question. I'm just keeping it down to 1 mark. I'm thinking the carrying value of the asset is 150. We have got a gain in profit of 50. Put that in a box. Everybody's happy. Step 2. Tax base. Temporary differences are the differences between the carrying value, we know that is 150, and the tax base. The amount attributed for taxation purposes. If we are the tax man and we see there is a gain of 50, a paper gain, a non-cash gain, a revaluation gain, do we assess it for tax straight away, yes or no? No. There is no current tax assessed on that gain. It would be unfair because, quite simply, the company hasn't generated any cash to pay the tax. So there will be no current tax assessed on that gain. So therefore, for tax purposes, the gain of 50, ignored. So what's the tax base? 100. Excellent. Put that in a box. So the first thing we've achieved, step 1, we know the carrying value is 150. Second thing we've achieved is step 2, we know the tax base is 100 because the revaluation gain has been ignored. Step 3, now that we know the carrying value, now that we know the tax base, we can work out the temporary difference. What we've got here is a gain, and the gain is a taxable temporary difference. So we've got an accounting gain which has led to a taxable temporary difference of 50. The tax rate that we've got is 25%. So therefore, with an accounting gain, which gives us a taxable temporary difference, this will give us a deferred tax liability, and the deferred tax liability will be 25% of 50. Hey presto, the answer is 12.5. I'm going to say it all again before we write it down. Step 1, carrying value. Carrying value is 150. Step 2, tax base. Tax base is 100. Step 3, you've got an accounting gain, a taxable temporary difference. Yeah, 25% of 50 is 12.5. It is easy. It is straightforward. But there's a process involved if you are going to gain 2 or 3 or 4 marks for the explaining of what is going on. So I'm about to write something down, but what I write down you are comfortable with, yeah, so far? So far. Right, okay.